Hello and welcome to our today's session. My name is Stella Chege, an IFRS consultant and trainer in AARO Academy. AARO Academy is your competence partner in group reporting. In today's session, I would like us to look at consolidated financial statements under the scope of IFRS 10. In this session, we will answer 5 questions. 1. What are consolidated financial statements? 2. Why do we prepare consolidated financial statements? 3. When do we prepare consolidated financial statements? 4. Who prepares consolidated financial statements? And finally, how do we prepare consolidated financial statements? What are consolidated financial statements? These are financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of a parent and a subsidiary are presented as one single economic entity. Consolidated financial statements include the Consolidated Statement of Financial Position, the Consolidated Statement of Financial Performance, or in other words, what we call the Profit and Loss Statement, the related notes to support the Consolidated Statement of Financial Position and Financial Performance, and finally, the Consolidated Statement of Cash Flow. Why do we prepare consolidated financial statements? As I had mentioned before, consolidated financial statements are the financial statements of the parent and subsidiary presented as one single economic entity. So through the consolidated financial statements, stakeholders are able to get an overall picture of the holding company. Consolidated financial statements provide financial information about the resources that are controlled by a group and the results achieved from utilization of these resources. Consolidated financial statements also show the intrinsic or true value of the share of the holding company. Finally, consolidated financial statements can be used in the market to analyze a holding company, and this is very important, especially to investors. When do we prepare consolidated financial statements? An entity prepares consolidated financial statements when it has control over another entity. What do we mean by control? An investor has control over an investee if it has these 3 things. 1, it has the power over the investee. That means it has existing rights that give them the ability to control this other entity. This could be through majority voting rights. 2, it has exposure to variable returns. This is due to the involvement with the investee. For example, the returns it gets could be a share of the profits, for example, through dividends. These dividends could be changing due to the performance of the investee. And finally, it can use its power to control the investee and therefore influence its returns. So this means it can use the power it has, which could be voting rights, to influence decisions in the investee. Who prepares consolidated financial statements? Consolidated financial statements are prepared by a parent who owns one or more subsidiaries. The parent company takes its own financial statements and consolidates it with the subsidiaries' financial statements to present one financial statement as one single economic entity. As a best practice, consolidated financial statements are presented in a similar format to that of the parent's separate financial statements. We have looked at what are consolidated financial statements, why do we prepare them, when do we prepare them, and who prepares them. Now let's look at how we prepare consolidated statements. To prepare consolidated financial statements, an entity follows the following steps. 1. It applies similar accounting methods to the parent and the subsidiary. It is advised that the accounting methods used by the parent and its subsidiaries should be similar. However, in the case that these accounting methods are not similar due to changes in jurisdictions, then the parent is supposed to pass adjustments to arrive at similar accounting methods. The next step is to ensure that the currency of the parent and its subsidiaries have been translated to the group presentation currency. Once this is done, the parent entity combines like items, that is, the assets, the liabilities, income, expenses, cash flows, and its equity to those of its subsidiaries. Once this combination is done, the parent entity is required to eliminate any intra-group transactions. Intra-group transactions could be intra-group sales, intra-group purchases, intra-group receivables, intra-group payables, and any unrealized profits in its inventory. Once this is done, the parent entity is now required to eliminate its equity against the investments held in these other subsidiaries. Through this elimination, the group financial statements record a goodwill, if any. Once this is done, the parent entity is supposed to allocate the profit or losses and any changes in equity that have been reported as a group to the parent and to the non-controlling interest. By non-controlling interest, we mean these are the shareholders that do not have control over the subsidiaries, what was initially called minority interest. So once this is done, then the consolidated financial statements are done. Thank you for joining us in this short introduction on consolidated financial statements. For a more elaborative and practical experience, we invite you to visit our website and register for our trainings. Thank you.